Hi, everybody, and welcome back to video number 3 in chapter 15. And when we left off, we were looking at a schedule of the cost of goods manufactured. And here we start off with the direct materials that we used, direct materials, and direct labor, and the applied factory overhead based on the predetermined overhead rate. And that gives us our total manufacturing costs. Then we add the work in process beginning inventory, which in this case was 0, and that gives us the total cost of work in process. Then we back out the ending work in process, and that difference is what we move to finished goods, the cost of goods manufactured. Major concept there, so be sure you pick that up. Okay, so now here is the Road Warriors income statement. They've got our sales here, the 5,500, the one car that they did sell, the cost of goods sold, and the gross profit, and our period expenses, selling expenses, and general and administrative expenses, and our net income of $600. Now, the inventory balances, we kept raw materials. That would be the ending raw materials inventory balance of $1,400, the ending work in process inventory balance of $3,420, and the finished goods inventory that we still have yet to sell of $6,000. So our total inventory is $10,820. Now, you'll remember that way back we had that $200 of a debit balance in the, let's go back, debit balance in factory overhead. Here's our actuals, those are debits, and here's what we applied, which was 67. So we didn't apply enough to use up that $200. So we are what's called under applied overhead. So let's look at that. The actual overhead costs and the applied overhead cost. If we don't apply enough, it's under applied. If we apply too much, it's over applied. So in the case where our actual is greater than what we apply, the overhead balance is going to be a debit, and the overhead is under applied. The jobs, therefore, are going to be undercosted because we haven't applied enough overhead into the jobs. So we make a journal entry to correct this on the financial statements by debiting cost of goods sold, which increases it, of course, and crediting factory overhead. While that does fix the $200 debit balance that we had, if you go back to that schedule I just showed you, the problem is that the jobs are still undercosted because this cost of goods sold does not go to the jobs. Now, if actual is smaller than what we applied, then the overhead balance is going to be a credit. We will be over applied, the jobs will be over costed, and we do the opposite journal entry where we debit factory overhead and credit cost of goods sold. Very important. Okay. Now, if we adjust that, here's that example, the $200 under applied overhead. We're going to debit cost of goods sold and credit factory overhead, and that closes, that's a closing entry here, under applied overhead costs. Now we're ready to go. All right. Job order costing of services can be used. Job order costing to services companies. There's differences, though, for service firms. One, service firms do not have raw materials or finished goods inventory. They have supplies, but these probably would be considered just overhead. Direct labor is used to apply the overhead, and typically we would use different account titles, such as services in process inventory and services overhead. Okay. And here, if we look at a balance sheet for a service company, here's our direct labor and our overhead and how we apply it to our jobs. And some of them are sold and some of them are kept in the services in process inventory. Same exact theory, except tailored to a service company. Okay. Now, applying job order costing in pricing of services. Here, the service providers also use job order costing, as we just described, and the cost for each individual job are tracked separately. So total costs include labor and overhead. This would apply for, let's say, a law firm where you have lawyers working on a job, and you have secretaries working on a job, and you have some paralegals working on some jobs, etc. So they would have overhead and labor. So here's their direct labor. In this case, they've got designers making $65 an hour and staff making $50 an hour. So their direct labor was $5,845. Their overhead was $104 hours at $108 per hour. So they have big overhead, of course, and that would result in $11,232. So the estimated job cost is going to be $17,077. So if we use a gross profit ratio for services company, we're going to take the service revenue minus the cost of the services divided by the service revenue. So one, service providers also use job order costing, and two, the cost for each individual job is and are tracked separately. And three, the total costs include both labor and overhead. Okay, and that ends chapter 15. And when we continue, we will look at chapter 16, where we will start to explore process costing and how that differs from job order costing. Until that time, bye for now.